I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a riskalyze test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our idea, our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Hello, welcome to Financially Speaking with Jeff Bush. My name is Steve Jablonski, and I'll be the host for today's show. Today we have a couple very interesting topics. First of all, we're going to talk about the stock markets in general, their all-time highs, and the associated volatility that comes along with this. And then secondly, we're going to talk about risk and talk about a Nobel Prize-winning software called Riskalyze, which really helps people identify their true risks. So with that said, morning, Jeff.
Well, hello, Steve, and welcome to the show. Great to be here on PCTV, and of course, the show is taped right here in the halls of Pottstown High School, and we show the program locally on cable, but also, and just as important, the show is also broadcast on the web on thepctvnetwork.com. And of course, we put it on our website too, which is informedfamily.com. So that's all good stuff. And of course, we've been here now, I believe we're well into our 5th year of this show. So we're kind of rolling along here, and it's certainly great to be here. And of course, we're operating in volatile times. You know, here we are in the beginning of 2018, and depending on what day you're watching this show, the market could be way up or the market could be way down. So these are interesting times, to say the least.
And Jeff, we've Informed Family's been getting some very good press lately. Why don't we hop into that?
Yeah, so over the course of the last year, we've had the good fortune of really being in the news. I wrote an article for the Reading Eagle a couple months back, and of course you were featured in the Norristown Patch. Our colleague Barry was in Investopedia and Yahoo News, and I was featured in the U.S. News and World Report. So it's a lot of good publicity that we've had the good fortune of having, just to kind of get the word out about who we are and what we do, along with doing this show as a medium.
Yep.
So it's all good.
And Jeff, I know most of your clients come from recommendations and referrals. What else do you do? You know, how do you get out in front of the public?
Yeah, well, certainly the recommendations and the referrals are key to our business. But we also do workshops, public workshops, and we got one coming up in a couple of weeks at Lily's Grill, which is right in downtown Pottstown, near our Pottstown office, as a matter of fact. So if you're ever interested in coming to one of our public events, just call our office and we can make sure that you get tickets to come out to see. That particular one, we're going to be talking about Social Security, which is a hot topic always a hot topic. I was going to say it's a hot topic now, but it's always a hot topic.
Yeah. And getting into the markets, historical highs, what type of volatility goes along with that?
Yeah, so, we like to say this is not your father's stock market. Okay, so if we look at the stock market back in the 80s and the 90s, it was, for the most part, on an upward slope. We had some volatility, but not much. I mean, you can see on the graph that we have here that the market was pretty much on an upward slope, and we had nice steady returns over that period of time. But something happened when we got into the new millennium, and now we're experiencing volatility almost on a daily basis. It's really quite fascinating, and really for the average investor, it's tricky. These are tricky markets to navigate through.
Yeah, and if we put it in better perspective, when if the Dow Jones is at 25, 26,000 versus years ago when it was at 12 or 13, people hear of a big loss, but when we talk percentages, what's that look like?
Well, that's true, but you were still, so it used to be 100-point day in the Dow was significant. Now it's almost nothing, just because of percentage. I don't want to say it's almost nothing. That's not quite true, but it's not like it used to be, where I remember, and maybe I'm showing my age here, but I remember when the stock market went, this is probably in the early 90s, when the stock market went up by 100 points. I was like, wow, that's a big day in the market. Yep. It's huge. Now it's almost nothing, because the Dow's at 25,000, let's say, versus back then when, I don't know what it was back in the 90s, but let's say it was maybe, 5,000, 6,000.
Yep.
A lot different. But the fact of the matter is that we are in volatile times, and that is not going to change. So when we look at 2017, the market was pretty much up the entire year. We didn't have any you bounced around a statistic on this that we didn't have a day.
Yeah, like for example, for Friday, we were down a little bit over 2%. And in 2011, over 20 days that we had down over 2%. And 2015 and 16, five and six different times during the year, the market was down over 2%. 2017, that didn't happen. And it was pretty much straight up.
Right. Yeah, and that is, so 2017 was unusual in that regard, and even the beginning of 2018 is the same thing. So I guess what I want to say is stock market investors who can't take a one-day drop like that, where the market goes down over 2%, or even a 10% correction, we question whether those people should be in the stock market to begin with. Those that can remain calm and stay invested will be rewarded. Now, we have a lot of tools at our disposal at our firm that speak to this. We're going to talk a lot this morning about Riskalyze, and that is a tool to measure risk. We also have another process that we use called Asset Cycle Portfolio. And in a nutshell, what Asset Cycle Portfolio does is it assigns a timeline to every single investment in your portfolio. So quite simply, Steve, if you're long with an investment, meaning your time horizon is, let's say your time horizon is 10 years or more, 15 years or more, you're not concerned about a 1 day 2% drop in the market.
Right.
You're not concerned about a 10% correction in the market. But again, you've got to score correctly on this riskalyze, because there are people who simply do not have the stomach for this kind of volatility. So we're not sitting here saying the stock market's for everybody, because it's simply not for everybody. And some people just don't belong in the market for other reasons.
Yep.
So it's all part of a broader financial plan. So, you know, we banner this stuff around all the time, and the media just, you know, drives it to death, just like they do everything.
Yep.
But the stock market investing has to be done under a broader financial plan.
Yep. And when we talk about riskalyze, and is it like a speed limit almost?
Well, yeah. What riskalyze does is it's like it assigns a number to everybody has a score. It's like everybody's walking around with a number.
Yep.
Okay, and the bigger your number, the faster you're going. So yeah, if you have a risk score of 70, yeah, it's like you're driving down the highway at 70 miles an hour, which means you're taking a lot more risk than the person who's driving down the highway at 40 miles an hour, because you can't react as quickly.
Yep.
If you're going faster. It's the same way with being invested in the market. It's the same thing.
And so if we look at 1 versus 99, what would be more of a typical investment on the lower side?
Cash.
Okay.
The money market.
Yep.
You know, investments that have little or no risk to principal.
Yep. And how about on the higher side?
Well, the higher end would be, you know, your growth stocks. Could be a technology stock. It could be some new offering. It could be a penny stock. You know, could be you know, a lot of different things. But it's investments with high volatility.
Yeah. And for years and years and years, it seems like people would kind of get, I don't want to say pigeonholed, but categorized into if you're a conservative investor or if you're an aggressive investor. And when you look at that versus riskalyze, was that more like people could they identify with?
It wasn't really quantified. So you would just say, oh, you're talking to a 25-year-old. Well, they must be aggressive.
Yep.
So we'll put them in stock.
Yep.
Oh, you're 80 years old. That must mean that you're conservative. That must mean we better put you in a nice portfolio of bonds. It's just not that simple. And what our riskalyze, our award-winning riskalyze software does is it allows us to determine on a more quantifiable basis just what an investor's risk tolerance is, and therefore that allows us to do a better job with asset allocation, meaning we can put them in different investments which are in line with where their risk score is.
And you had mentioned to me that in this software, it actually can compare like almost a worst case scenario of the 2007-8 markets to their risk.
Yeah. So the neat thing about this is it tells you, you know, where your score is. It kind of gives you a range, like a high and a low. So it can tell you, well, yeah. So let's look at a bad market. So you use the example of 2008. So in a bad market, this is how you would have done if you were invested according to this risk score.
Yeah.
So in 2008, you would have lost 40% of your portfolio, Steve. How does that make you feel?
Right.
Well, you know, if you say, I can't stand that, I can't tolerate that, then maybe we need to reassess your risk score.
Yeah. So this is great. So this is really one tool that Informed Family uses. Tell me a little bit about the planning that goes on there.
Well, the planning is key. You know, that's why our clients that are in the stock market, they're in there for a reason. It's just not, they're not just in there haphazardly, they're in there for a reason, because we have a financial plan that's there to meet a lot of goals and objectives, whether it's income now, income later, liquidity needs, emergency savings, long-term growth, your legacy. There's a lot of reasons why we want to be invested. So if we have, I guess the easiest way to say this is, if you have your short-term needs taken care of, then you can afford to be invested long-term in the stock market, as an example, and then you can take the volatility. You're always going to have volatility, whether it's, we showed that graph, your father's stock market, your stock market. You're always going to have volatility. But if you're invested long term, even now, as we're 10 years out away from that, what seemed at the time the tragedy of 2008. But if you stayed in the market, you just had the raw nerve to stay in the market, or better yet, you had a financial plan. If you stayed in the market, we're well past that. We've exceeded that. We're seeing 10-year numbers now where we're seeing 10-year averages of 10%. 9, 8, 9, 10, depending on what investments they are, what indexes we're looking at. But point is, we've recovered from that. And it's because it's long. We're long. We took a long view. If you're taking short views, and you and I have had many conversations with our clients about this, and if you can take a long view in the market, you will be rewarded.
And there's always been, you mentioned asset allocation. What about asset designation? What does that look like?
Well, asset designation would meaning that you assign you have assets that go with certain risk that you're taking,
or duties that they have.
Yeah, so every asset has a job description. So you look at a portfolio, and this asset is designed to give you income now. This asset is designed to stabilize your portfolio. This asset is designed for long-term growth. You're really designating assets along a timeline, and that's also a risk management tool.
Mm-hmm. And what advice would you give people that are actively investing in their 401ks today?
Well, the nice thing about a 401k, and by the way, the 401k in the financial world, it's probably one of the greatest inventions of all time, because it's really the way to grow wealth, Steve. There's really no secret to growing wealth. You really have to do it one paycheck at a time. And if you're systematically investing in a 401k, it's a great thing. And when the markets are going down, you're simply using a technique called dollar cost averaging, which is a very natural thing with a 401k, because you get paid, most people get paid like every 2 weeks. So every 2 weeks, you're dropping money into your 401k account, okay? So the markets are up, the markets are down, and you're averaging yourself in. And with that discipline of averaging your way into the stock market is the best way by far to grow and accumulate wealth. And then you add to that the match of your potential match of your employer, which I call free money. You'd be a fool not to participate in something like that. And how you should be invested in your 401k That comes back to your risk score. It comes back to your timeline. Of course, your younger investors have more time, so they, can be more invested in these equity funds. If if you have a compressed time frame, meaning retirement is imminent, then your investment portfolio should reflect that. And a lot of these 401k plans now have these target accounts or target funds, which means they, so let's say target retirement 2030.
Yep.
That means that you're set to retire in the year 2030.
Yep.
Okay, so you have about 12 years. So they adjust the portfolio with a mixture of stocks and bonds according to you getting to that year 2030. So as we get closer, the investment allocation adjusts automatically. That's a great thing. You don't have to think about it.
Yeah.
So there's really a lot of neat tools out there now for 401ks. And if you're working for a company that offers a 401k or maybe the nonprofit counterpart like a 403b,
yeah.
you got to do it. You got to take advantage of it. It's like it can be slow, it can be minimal, it's painless, and you don't miss the 1 or 2 or 3% or whatever the number is coming out of your paycheck.
Yep.
every time. It's forced savings, and it's a great thing.
And Jeff, one of the things we talked about that we just wanted to touch on before the show is we just had a tax reform or tax change. Is there a couple high points on that you want to share with folks today about that?
Yeah. So, where do we begin with that? There's really a lot to absorb with the new Tax Act of 2018, and a lot of it is tax cuts across the board. The rates have been lowered in almost every category. And starting at, as we tape this in February of 18, people should start seeing increases in their paycheck because the reflection of the lower tax rates. There's sunset legislation on these lower rates, though, which I'm not sure exactly how that's going to translate, but they're set to expire in the year 2025.
Yeah.
I guess you could say between now and 2025, you can expect more changes.
Yeah.
But the whole point of the tax changes were to simplify the taxes. Now we're talking about our friendly government now, so how simple is it really going to be? Well, they did a couple things. They lowered the tax rates. They increased the amount of itemized deductions. So it went from, and you're more familiar with these numbers than I. The standard deduction went
Almost
from,
doubled. Yeah.
It doubled.
Yeah.
So it went from like 12 to 24 or something like that. I don't know the exact numbers, but they went up significantly.
Yeah.
So more people are just going to take the standard deduction rather than itemizing deductions. And they're phasing out a lot of the stuff that you would normally deduct, like interest and property tax. I think they put a limit on taxes, $10,000 with state and local and that property taxes and that kind of thing. They eliminated the personal exemption, which kind of offset the increase that they made in the standard deduction. And then they made some changes to the alternative minimum tax, which is a very complicated alternative that they do, like just to kind of add back some of the things that you were otherwise deducting. So it's really a little tricky, and I would encourage people that as they do their taxes for 2017, they should be looking ahead to 2018 and see how all these changes are going to affect people individually.
Yeah.
But by and large, for most people, they're going to there's going to be more money in their pocket.
Yeah. And Jeff, for people that may not be using an advisor and they don't know much about them, what would you say for a couple things of what should they be looking for in this?
When you're going to work with a financial advisor, there's a couple things that are key. Number one, you have to be comfortable with that person, because you're putting a lot of faith and trust in that individual to steer your financial future. So you have to trust that they're working in your best interest. So you want to make sure that the financial advisor has a fiduciary responsibility to work in your best interest. Now, last year there was a whole bunch of legislation bantered about that came under the Department of Labor ruling that kind of forced all of us in the industry to act in a fiduciary capacity. And I always question, why are they forcing people to act why are they forcing financial advisors to act in a fiduciary capacity when we should be doing that to begin with? And of course, you and I, because of the licenses that we hold, we were already doing that. But there was some things changes that they made to I guess increase the protection of the consumer, which was good. But that's important, that your advisor's working in your best interest. The other thing is you want to work with an advisor who's independent.
Yep.
Because when you're independent, you have the world of product and service available to, rather than just like you're working for one company, you're working for one wirehouse, one insurance company. So the independence is really, really key here. But you want to interview advisors and make sure that they're doing what they're supposed to be doing, interacting in your best interest, because there's a lot here.
Yep.
And it's tricky to navigate. So with that being said, we're at the end of another show here. So until next time, this is Financially Speaking with Jeff Bush.